There is so much going on in the market I want to discuss, from individual stocks to the broad view, housing, interest rates. Are we heading for a recession at the end of the year? Is this the end of the bull market? And I'm going to sit here and tell you right now, anybody that actually knows what's going to happen tomorrow is a liar. They are a speculator. They are a gambler. I am always going to be a long-term bull. Every dip is a buying opportunity into the potential future of your retirement 20, 30 years from now. And anyone telling you otherwise, like I said, pure speculation, because right now everyone is running with this headline that the big short Michael Burry has just made a $1.6 million bet against the stock market. Oh my God. But meanwhile, at the same time, he is buying stocks like Expedia. I mean, he's buying everything from CVS. I mean, MGM Resorts. He added so many new holdings to his portfolio, and he's basically just took some puts against the market. And if I've learned one thing about Michael Burry is that he's a short-term speculator. He's playing the volatility of the market. He's going to close out those puts. Who knows what they actually are or the time frame for them, but he's going to close them out as soon as the market volatility happens. Like if it goes down slightly, he's going to get out. He did the same thing with Tesla. These big headlines hit, it spooks the market a little bit. Some things sell off. We're in a kind of a sell-off period. He's just going to take advantage of it. He's not betting against the market here, folks, because it's kind of counterintuitive to short the market and then go long a ton of stocks. And I'm telling you, he's going to sell out of that by the next quarter when we hear the following filings. He'll be done with it. He'll take a bit of profit if he's so lucky to get some profit, which at this current moment, presuming the market continues to pull back, which again, nobody knows if it's going to continue to, but it's not the news that's driving this pullback. I mean, you take a look, inflation pumped up in the US. It pumped up in Canada slightly. There's fear of further interest rates coming into September. We'll see what the August inflationary numbers look like. But this is a two-edged sword because inflation isn't being driven by traditional consumer prices going up, like, basic things. It's more or less caused by the same things we've been hearing about, caused by the interest rate hike, which is housing. A little bit of gas is playing into this, but a lot of this has to do with mortgage rates and the cost of, rent going up. And a lot of these are just inflicted by the interest rates, because interest rates go up, cost of housing goes up. People that are landlords have to increase it on their tenants. And this is a self-inflicted wound. So for the Federal Reserve, the Canadian Treasury, Tiff Macklin here in Canada to raise interest rates again, I think comes from a place of ignorance, in my opinion, if they were to do it. I'm not going to speculate on it. Honestly, I think I would prefer interest rates to go up. As somebody that just bought a piece of real estate, it doesn't matter. We're already locked in at crazy high rates of like 5.8%. We got in before the last hike. That doesn't matter to me, right? Because we're playing within the realm of controlling our finances. But I do like it from the fact of bonds and GICs. But obviously, interest rates are holding 20-year highs, things we haven't seen in a long time, and how this is going to afflict the housing market is still up in the air, whether it's going to be a soft landing, because housing is going to dictate if we head into a true recessionary environment, in my humble opinion, right? Because homes in the US have actually corrected on a more broad scale, but the US has so many overpriced cities that if in those overpriced cities there's mild corrections, when we're talking about multi-million-dollar properties, it tends to affect the broader housing market, whereas there's places in the States where housing is still going up. Same with Canada, right? Canada on a 12-month trailing, housing is still up by like 7% across the entire country because it's barely corrected in Toronto. But on a month-over-month basis, things have started to cool off again a little bit. The problem is the inventory is completely wrecked, right? Because people that are locked into their mortgages, they don't want to sell. They don't want to get into a higher mortgage, so they're sitting on it. Not enough new homes being built, so all these immigrants coming into especially Canada, we can't keep up with it, right? So it's really stabilized the housing market from crashing. And if housing kind of persists in the level it's persisting, I can't foresee why we're not kind of in a soft landing moment. And the only people getting really wrecked by this entire market environment are people that are renting, obviously the lower income of society, which is really sad. But unfortunately, Canada is mostly made up of rich people. And anyone that owns a house, like housing is for the rich now. People that have had time to accumulate over the last decade bull run, those are the people that are benefiting actually from this current market environment. They have tools, room to play around with, like Warren Buffett, who could potentially be shorting the market as well by going so much into cash. I mean, Warren Buffett's sitting on a record level of cash, right? And a lot of people have the opportunity to put that cash into bonds, GICs. We'll talk about that in a moment. But from a broader market perspective, is the crashing. I mean, we almost tapped all-time highs, and the S&P's down 3%. Whoop-de-doo. The TSX is also down about 3.7% here. The NASDAQ dumped about 5%. The only people that are experiencing like real volatility are people that are speculating on individual stocks. And if you're speculating on individual stocks, as I've always mentioned, make them a mitigated part of your portfolio, because you can always cost average into the index, have the best companies weight at the top. And again, over a 20-year cycle, it's just becoming the easiest factor of performance, because there's just no way of knowing what's happening with companies right now. I told you, like 2012 to to 2019 to 2020 was roughly the best time period of the market because companies were so predictable. All the mega cap, tech companies, they were posting double-digit revenue growth. Yeah, they were trading at a premium, but they had good reason to. Now companies like Apple have seen 3 consecutive quarters of negative growth in their revenues. Yet the stocks are hitting all-time highs. Like there's no way to justify anything going on in the market with individual stocks. You need to be very careful and presume the stocks you're buying have very good moated businesses, and as their stock price goes down, you could be comfortable cost averaging, because a lot of people buy the tops, and when stocks tank, they don't actually buy the bottoms. I mean, you look at NVIDIA and Meta, these are companies a lot of people are chasing right now, and I think NVIDIA is going to be the primary indicator to this kind of AI bubble that I think we're currently sitting in. Depending on what happens next week when NVIDIA posts earnings, this was like the golden child that started representing the AI movement. Then ChatGPT came out, Microsoft got involved. We've seen companies like Palantir here come into this movement. And the scary thing is when everyone and their grandmother puts an eyeball on it, it means they need to excel. And these companies like Palantir that posted earnings, I didn't see anything that said, hey, this thing is accelerating to justify the stock price. And they can hate me for that opinion, but I don't think anyone's denying it when their growth rates have just generally been slowing down. There's nothing in these numbers that say scream that the stocks should be just flying like this. But NVIDIA will be the primary factor. If NVIDIA posts blowout numbers and chips are just, really growing on cloud and AI software, which we're seeing with Google's cloud, AWS, with Amazon, Microsoft, those cloud-based part of their industries and their companies are exploding. So who knows? Maybe NVIDIA is seeing a huge benefit from this, and maybe they'll post numbers that continue to excel the stock. But I'm very cautious here when it comes to the AI sector, right? In other news too, you got companies like PayPal that I personally still believe are relatively discounted companies here. I mean, the price to earnings, everything is falling off on this, and it's just because of a lot of news that might just be fluff. I mean, there was some activist traders that sold out of the company last quarter that were trying to, basically manipulate the old CEO to start cutting costs, do things to save some more money, and it worked to some extent. But now the CEO is dumping out, they're getting new management, a lot of internal stuff going on. But I think PayPal's got a decent moat here. They're not growing at an accelerated rate, but the base of transactions, as we talked about on their earnings, has gone up with the base of users they have. And again, this thing can only drop so much. And I think, again, similar to Facebook, I can't, if this thing drops down to like $30 to $40, I'd be blown away, but I can't predict on what happens tomorrow. This is a company that if you believe in it, again, you buy it here, and you have to have the cojones to buy the dips, folks. You really have to have real conviction into the long-term reality of the companies you're buying today, because the numbers just, they don't make sense anymore until we kind of get through this higher interest rate, lower growth environment. And speaking of that, I don't know how many people are still chasing the market anymore, right? A lot of money has been pulled out of the market. We've seen it with Warren Buffett. We're seeing it with these activist investors in many of these large cap companies. And there's so much other opportunity that I don't know if people kind of went through this flip-flop phase of they were putting all their money into GICs and bonds and high interest savings. And then, once the market started rallying, they were getting pissed. So they started pulling it out of that, rethrowing it in the market. Now potentially they're profit taking again, and maybe utilizing, as interest rates go up again here, that they're taking advantage of this. Because honestly, if we get another interest rate hike, this is what I'm excited for. If we can get closer to 6%, I'm really considering making GICs part of my investment portfolio. I actually never really ended up buying into any of these just because, again, we ended up doing this big real estate purchase. I ended up just holding it in cash, and I'm just blown away. I mean, we're not going back, I think, to where we were in the past where, we saw interest rates get up into the 8 to 10% level, because if we did, the markets are going to be in a shamble 100%. I don't think the Federal Reserve or the Canadian Treasury or the Bank of Canada are going to push to those extents. I think we're going to start seeing a leveling off in interest rate hikes. And if anything, and I'm again speculating fully, but I really think by this time next year, they will have cut rates and they'll start going back down to a more nominal area. So this is probably potentially a good time to lock in long-term GICs, because they do compound on an annual rate. I still think it'd be great to get these at 6% if you could find them. But this 5% range is probably very attractive to a lot of investors. And even still, if you want to take advantage of the short term, there's a lot of ETFs out there, like the Cash from Horizons. There's a few different ones that relate to high interest savings accounts, because a lot of banks, they have these kind of premium rates to get you to sign up to their savings accounts, and they give you like way above normal interest rates, right? Because typically, even on high interest savings, on a basic savings, you maybe get around 2.5–3%, but these ones are yielding like ridiculous numbers. Right now, the gross yield's 5.4%. And again, this is paid monthly. You can liquidate it whenever you want. So why would I lock my money into a 2-year GIC at 5.3 when I can get a high interest savings ETF that pays 5.4 monthly? Well, this is more of a short-term Parker place for most people's cash because unfortunately, as mentioned, if we go into the holdings here, if you actually look up these banks, you could take advantage of the same thing these ETFs are taking advantage of by setting up new accounts and taking advantage of these promotions, because it's basically what these ETFs do. But these are short-term promotions. Usually these don't last for longer than 3 to 4 months, sometimes 6 months. So what these companies do, these ETFs, is like you can see National Bank, CIBC, Scotia are probably offering the highest promotions right now. You can go ask the bank to set up a new account, take advantage of it for 4 months, and then go find another account that's doing the same thing for as long as interest rates stay up to where they are, right? So if you just want to take advantage of it on a short term for the next year or two, you could do it this way where you're not locked into a GIC or a bond where you can't really get out of it as liquidly. But these are great short-term Parker places, in my opinion. There's no volatility to them at all. They're pretty much one of the safest investments. They are pretty much the safest investment you can make today. But on that note, folks, the broader market, like I said, taking the broad view of everything here, I just can't help but seeing this being a buying opportunity. I don't think these dips are going to go too far. Honestly, I could be wrong. Again, I'm speculating. Don't take that as financial advice whatsoever. But I would be, if I had cash available, I would start picking up some of these and continuing to cost average, because a lot of things have been trading down. I'd love to buy Tesla if it got closer to the $200 range. Every time I've set a price point, I've set it too low. So we'll see if Tesla gets there when it comes to a quarterly basis. Next quarter is not going to be good for them. They've already stated things are going to slow a bit. So maybe we can take advantage of that if the market continues to price some of that in. A lot of tech stocks are starting to pull back from some of the rallies. Amazon's probably a good buy on the dip here. Shopify's been getting pretty wrecked. The chip companies outside of NVDA have been getting pretty wrecked from their all-time highs, or from the recent highs they've experienced, like TSM. Look at even PayPal starting to rally back here, as mentioned. Like, you could probably see some of these as some pretty good dips to buy. Outside of that, we'll do some more deeper dives on some stocks. Let me know what stocks interest you, and we'll do full breakdowns. But I just want to do a quick market update because, again, these are just some super peculiar times, to say the least.